There it goes. Okay, now we are live, and it's July 2nd, 2026. I'm Tim Quast with Market Structure Edge, and market strategist Brian Wilson is back
I'm
from
back.
handing a daughter off to
hmm
a responsible spousal unit. That's good. Yes, congrats. And
Thank you.
and in fact, I'll hand it off to Brian, who will go first. I'll bet clean up today because I've been doing this. You've been listening to me blather on for the last couple of weeks. So, Brian, over to you.
Thank you. I appreciate that. Yeah, very, very, very blessed. My daughter got married a week and a half ago. In fact, she and her husband just are coming back from their honeymoon today. They went to Kauai for about a week and a half. So, huge, huge blessings in our life. Love my son-in-law. He's fantastic. Love my daughter, of course. She's fantastic. But yeah, we're very blessed. Well, I wanted to actually spend most of my time kind of going through some recent emails that I sent because I think it'll set the stage for where we're at now. We're halfway through the year. What does that mean for us? What does that mean for the market? It's been a little bit of a strange year, so maybe we can kind of go through some of the dynamics that got us to this place and time just by revealing really a couple of statistics. So I'll get things started off, and I need to go to my Monday note to get things started off. So we'll start off there. All right. So with the Monday note, we talked a little bit about quarter end rebalancing, and then of course the Russell rebalance had come into effect as well. Some interesting dynamics, interesting takeaways from the Russell rebalance, and we'll touch more on this top heavy concentration here in another note. But mega cap concentration is still increasing. You guys are very familiar with that, those that closely follow the big tech portfolio. But these are huge numbers. The top 10 companies grew 49% year over year, over 26 trillion in market cap. Huge year for the Magnificent Seven. I believe the Russell went through April 30th is when their cutoff date was. But 49% appreciation in the Magnificent Seven. That was not the case year to date. We'll get to that here in just a moment. The big keep getting bigger. 10 companies now exceed 1 trillion. Interesting takeaway here. Small cap actually had outperformance. It's been a long time since we can say that. We're seeing a lot of dispersion right now in terms of it becoming a little bit more of a stock picking environment. The universe itself keeps getting larger in terms of these Russell cutoffs. So that was some of the principal takeaways from the Russell itself. Let's go to our Tuesday note, and I'm sure Tim will have more to say on this because it's a little bit of a weird concept. Well, let me show you what I'm getting at here, and it's these very low short volumes, and we'll take you back for perspective. We'll start on a 1 year basis. And for those that are new to this look, what you're looking at here in green is broad market sentiment. That's our demand algorithm. Down below here is short volume, the use of borrowed shares in the marketplace. And if you look at it on a 1 year basis, yep, that's 1 year, you can see we're basically at the lowest levels that we have been over the course of the last year. You circle back to, what was that, last October? It was roughly at those levels. You really have to circle back 3 years to see comparable statistics. And Tim did a good job this morning. He was mentioning this short covering run right through here. This was coming through the election. Broad market was just gunning higher coming into the election back in November, a year and a half ago or so, continued to move lower from that point going forward. When it finally stopped moving lower, that was kind of the high water mark for the market at that particular time. So, a couple of considerations here. We'll get to that high water mark here in just a second, but let's go back to that edge note. Did a little bit of research, did a little bit of thinking in terms of, what does low short volume communicate when the markets are generally moving higher? And that's the environment that we've been in. In general terms, well, there's reduced demand for bearish positioning. There's lower overall hedging activity. Sometimes there's a little bit of investor complacency. You combine those things together, what's your takeaway? Well, right now there's little appetite for bearish positioning, and the market is exhibiting signs of confidence or complacency. That would be kind of the principal takeaway in a market that's moving higher with low short volume. I did mention one curveball though, and we'll talk about this here for one moment. Could low short volume also communicate that there's less overall demand for shares at these levels? And what I mean by that is just less of a need to borrow shares to facilitate daily trading. So let's go back to the graph here, and you can actually see how it played out here. When we reached our low mark here back in, what was that, December 2004, the market just marginally moved higher up until February, and then we went into a tailspin for a little while. But part of what I saw when I was looking at this 3-year chart, just as you have demand, you have rhythms for demand. So sentiment moves above the red line, it moves below the red line, and it moves back and forth over time. Those are normal cycles in the market. Short volume has normal rhythms as well. And you can see after our low mark there in December, those rhythms kind of stopped. We never made it back up to where we were before, and they became a little bit disjointed. And I'm wondering if we're getting into a similar cycle now. So you can see the normal rhythms, normal short volume rhythms. So think of this as just borrowing of shares to facilitate daily trading. The shorts get covered, they get borrowed again, they get covered. It's a normal rhythm of trading. But we see what's happening here. And this last cycle, it didn't go as high. In other words, to me, there wasn't as much borrowing of shares to facilitate the normal trading that we see. And then we've moved lower once again. So I'm wondering here if low short volume is actually an issue right now. Now, normally you would say low short volume is great. Yes, it is. But at the same time, we need healthy demand for low short volume to be great. And you can see our demand cycles have started to fall off a little bit. We're not getting those same rhythms with demand that we've had previously that took the market higher. So I think we're starting to see a disruption right now, both in the demand rhythms and in the supply rhythms. And we'll circle back to these concepts when I take a look at the path ahead. Last item is from the Wednesday email, and this was looking at kind of the recap of what we've seen so far year to date. It's been a fascinating year. This I didn't even realize this until I did a little bit of research. The only member of when we talk about the Magnificent Seven, the only member of the S&P 500 with positive year-to-date performance, and this was as of the 30th, was actually Meta. That was crazy to me. The average returns negative 4.9%. Microsoft just got destroyed, negative 14.6. But at the same time, the S&P 500 had returns of over 9%. well, we haven't seen that in a long, long time, right? You do the math, and the S&P's up 36% at the end of the year, 36, 37%. What's going on? Well, underneath the hood, we're getting a lot of huge movement from a lot of these companies. What are we talking about here? We're talking about AI infrastructure, memory, storage, semiconductors, data center equipment. You've seen the semi trade for those who are in the model portfolios. Time after time after time, those keep getting ticked because that's where the money is. So this right here is basically why we had 9% performance during the first half of the year. But sorry, I did the math wrong, didn't I? 18% for year to date instead of 36. I was looking at it at a quarterly basis. But it took a lot of energy, huge energy, to move the market forward by 9%. That's part of the risk that I see right now, is that these companies, SanDisk, 800% performance, Intel, Western Digital, Seagate, Dell, Marvell. That's huge performance. You don't see that very often, and these are rather large companies as well. So we did see a little bit of the broadening of the big tech trade, but it was almost, and we've talked about this. This became like a memes. All these became like meme stocks. So very crazy, a little bit dysfunctional, if you think about it. That first half of the year, tech continues to become even more dominant. I did a comparison between 2021, and these are approximations. 2026 is pretty accurate, but this is an approximation. But look at the growth here. Tech growing from 28 up to 36%. Financials kind of staying steady. Healthcare actually decreasing a little bit. Most of the other ones had marginal movement. So your takeaway, if you're part of the S&P 500, and we wrote about it here, what does that mean? Well, you have even greater exposure to technology now than you did before, and you're getting a lot more exposure to AI-driven businesses. If you're comfortable with that, that's great, but that's basically what's happening, when you buy the SPY, for example. With that being said, I'll take a quick look at the path ahead, and then Tim can add to it later, and I'll circle back by, I think, making this a shorter term view. What I see is, I think we need demand to heat back up. I'm looking for three elements to heat back up all at the same time. I'm looking for sentiment to bottom and start moving higher. Sentiment's in a bottoming process. It probably starts moving higher with today's trading. Ironically, I'm looking for short volume to actually start moving higher. I talked about the rhythms of the market. I think we're in a rhythm where we're not getting as much borrowing, and we actually need borrowing of shares for the market to function properly, if I can use that term. And then lastly, for my look ahead is big tech. I need big tech to rebound. Right now, big tech is weak at 2.7, and sentiment is moving higher. That's a state of convergence for the big tech trade. So for the market to move higher in early July, I'm looking at three elements moving higher at the same time: big tech, sentiment, and ironically, short volume. So that's kind of my look ahead, and I'll turn it over to you, Tim.
Excellent. Thank you, Brian. So there's an acronym that comes to mind for those seven. You could maybe put AMD in there too. I mean, they're another stock that it has had similar characteristics, but it's some wisdom. SanDisk, Micron, Western Digital, Intel, but Seagate, Dell, and Marvell. Some wisdom. I mean, that's there's not Nag 7. And
Yep.
how long will that wisdom last? I don't know.
That's good.
They're taking a shellac. It looked like today they're taking a shellacking
And yesterday.
today.
Yep.
Yeah. Okay, so any questions, comments before I hit my high points? Dan, let me see. Um, Palantir. Okay, we'll take a look at Palantir. Let me share my screen. Bear with me a second here. Okay. And we'll do that, Dan, first. I can turn attention to that. Okay. Everything's moving slowly, like me today for some reason. Okay, so Palantir. I mean, it's a one. It would be interesting to profile it to, some stocks do work well buying at a one. I looked at this generally, it's not what I would buy, but on the other hand, what does the math tell us? If you were to say it's a blunt instrument, it's not an awesome way to study the data, but it does give you an idea, that it will default to what if you buy when it rises over five and sell when it returns below. And you can, doing that produced an 8% return, and you'd been active for 38 days out of a total of 90 days in the period that we default to looking at 90 days. So it's vastly superior to buying and holding it, right? If you wanted to generate a return, that would be a way. But then let's say you buy ones, how does that work? Historically, it's not great. So, I mean, who knows? That's just a statistic. And maybe you buy ones and sell tens, and that gets you back to buy and hold levels. To me, it's not great. So I'd still I'd still trust the math to say that when it's over five, you should own it. It's just such a great, simple principle that if you own things that have demand of five or better, you're very likely, just on a probabilistic basis, to outperform the market. Okay, let's go back to the app. I think I have to do this. And this, okay.
Tim, could you look at the current setup for them with their short volume setup?
Palantir.
Yeah, I think that's what Dan was getting at.
Oh, I didn't read the whole thing, Dan. So if you look at the supply side, yeah, I mean, there was a steep drop, and this is really low at 35%. I mean, that's really low supply. The trend, the 2 day, it's not really a trend yet, is up. But would that tell you that's why you're getting a gain? You're right about that. There's no question that whether it's short covering or as Brian was explaining, it's a bit of a mental challenge to wrap your head around this idea that half the volume in the market at any given time is short. It's facilitating trades through exemptions to short locate rules, as I've explained a number of times. But you're absolutely right that that's low, right? That part is true. I just statistically, mathematically, this is not historically delivered reliable gains, is the only thing. It does better over five. Not always. I mean, clearly here the price was rising, but then when supply rose, price deteriorated. That relationship remains very true. I do think Brian's observation about declining short volume perhaps indicating that there is more. It isn't exactly how you said it, but does it mean there is more real supply in the market? And if the market isn't rising, because it's, on a central tendency basis, it's not rising. It's been in the same range where ever since demand went over six and then pulled back some, the market really hasn't risen. Right? It's could for a day, but the trend line is flat. The supply line has come steadily down and then fallen off the cliff. Does this, to Brian's point, mean that market makers are not having to exercise short exemption rules to fill trades because there's more real stuff in the market? And if there's more real stuff, supply shares in the market, does it mean people are starting to cut back on equity exposure. You would think it would be so easy to see in fund flows, that money is reducing its exposure like this. If this is Morningstar monthly fund flows data. And it's really interesting to look at the 10 largest fund families and you say, well, looking at the flows for May, at Vanguard, actively managed assets declined $1.4 billion. Passive funds increased by $37 billion. And if you do it on a trailing 12-month basis, $340 billion at Vanguard to deploy. So you'd say, well, that's probably going to lift the market. Well, is it? Because what if it's going into fixed income? You can drill down and see where it's going. And really, there is a growing bias toward fixed income in the data. And so why wouldn't you look at this? Well, all of this feeds into believe it or not, the leading indicator is this. The leading indicator is almost real-time demand and supply. Fund flows, lagging indicator. It will be too late by the time it shows up in that data to know what's coming. Okay, well, let's get to the core things that I want to cover in the remaining 5 minutes here. I also wanted the top item was why didn't item B happen? Let me explain. If you don't read the market desk notes, I wrote how, if you back up, let's do this. That's probably not going to help us, but it'll cover the period. So this breakdown below the green line that happened in March, first time since April of 25 that we had been below that green line. And I said, generally, two things happen. If you have a long stretch where excess demand keeps the measure, the quantitative measure, the algorithm above that green line, then when it dips below that, generally the two things happen. A, the market rises because that's a bottom. It's an entry point, and you absolutely go long there. That's a great opportunity to make money. And then so you get a very strong, whenever that peak arrives, it's a very strong move above the red line. And then B, about a quarter later-ish, you get another breakdown, except that hasn't happened. And so, well, why didn't B happen? Well, it's an historical central tendency that after a long period, you have a breakdown, there will be another one. And it just hasn't happened yet. I thought, well, there's a reasonable probability of that happening at quarterly index rebalances, options expirations, or at month end. Well, we've now gone through both of those and it hasn't happened. And if you look at the data, you say, well, there's no real indication that that's going to happen. Might not be. might not happen. I mean, it's just a general theme, not a specific one. And, so the answer is, I can't tell you why, that it hasn't happened. You could say the biggest reason why is the decline in supply. If supply declines, it supports the market up until a point that it doesn't. Here where demand was falling and supply was rising, the market really got clocked. Then you have demand falling, but supply fell and the market rose till it stopped. As soon as it bottomed, the market stopped rising. So we'll see if B follows. But the reason why it hasn't is it didn't. It just didn't happen, right? The next thing here, which leads right into this, is something we touched on last week, which is these weak tops. It's interesting to look back. Do I still have it? I wonder if I closed that. I don't see it. So I'll just do it. It doesn't matter. I can do this in real time. But when demand begins to wane, and it has here, right? You don't have demand. It gets to the red line here. It was over the red line here. It's not getting to the red line. If you look back historically at that, you could pick your time. I'll just pick 3 years here. When that condition has happened before, you could go back each time and see when the demand just weakens, then so does the market. The demand weakens. It portends pullbacks. You have pretty, even here, weak top, the market pulled back. Um, the breakdown came here. It's not quite as good, but you got that full breakdown. Here's an example of that. First break, and then about 3 months later, you get the rest of it. So I don't know what's going to happen, but these weak tops do tend to be indicators. And how long does it take? It tends to be weeks, but I don't know. These weak tops, as we say, weak tops precede drops, and it's a trope, and it may not always be true, but it is a consistent theme in the data that has happened before. So I note that same condition exists here. Right? It is the same condition, and the market is manifesting behavior that to me doesn't signal another pounding rise. Doesn't mean we won't get one. It just means that historically, when you look at these conditions, that's been the case. And I thought, Brian, you did a great job of pointing this out. Long decline. When it stopped, that's when the market dropped. And we've had a very long decline here. It's not the same pattern, but you get the general idea. One other thing I just wanted to note, so I ran a portfolio year to date that is near as possible with the blunt instrument of this utility that we use for the model portfolio. And we can model all kinds of things to the DTI Momo, the Daily Trading Ideas Momentum Portfolio. And it's done well. It's been as high as 50 some percent, 52%, but it hasn't risen since. And it's interesting, right? The daily trading ideas, if you were trading this kind of criteria, where you want to own stuff that looks like this. Sentiment is greater or equal to 8, and the trend is at least flat or up, equal to or greater than 0. Volume, 1 million shares, short volume, less than 50%. We're just looking for stuff that doesn't have as much artificial supply in it. The 1-day trend is down, just like the momentum portfolio. I set a price. I didn't want dollar stocks in it. So, I think it might be 10 in the model portfolio or in the daily trading ideas momentum portfolio. And then what we add here is exit criteria. So, if sentiment declines or the short volume 5-day trend is up, then you leave. And that's how you get this. And with the 10 stocks, performance is good, 31% versus 9% for the S&P 500, but it can't produce gains now. Those to me are telling features. So then it leads into the last thing, which is, are we in or out of the model? It's what I have been doing here, where the market doesn't give us strong signals, where there are weak tops, is if it bottoms, then you're in the model portfolio. And if it hasn't bottomed, you're not. So as Brian pointed out, maybe next week we're back in it with a bottom. I don't know. We'll see what unfolds the rest of the day and come Monday. But my conclusion to summing this all up with a look ahead is it's not that I wrote about Jerry. I get a kick out of Jeremy Grantham. He's a curmudgeon about the markets, but he manages $87 billion, and he's been very good at assessing these conditions. And who knows what's going to happen? I just look at this data and I think, well, there are many, many reasons to be cautious and to keep your horizons short, from the concentration risk, which is enormous. 138 stocks, or now it's 137, or 85% of market cap. It's staggering that all of us in all of our retirement accounts and our trading accounts and managed accounts and all these ETFs, there are now 4,900 ETFs in the US market as of the latest Investment Company Institute data. And they all basically depend on 137 stocks. I mean, that alone is a reason to be very, to approach these things cautiously. Because when you see an enormity of risk signals, one should be aware of it. And so how do you respond to risk? Well, don't overcommit. My longer term holdings, I've reduced my exposure to the equity market because I just think it's prudent. And then you shift your attention to shorter term strategies. And the machines do such a great job I mean, I think this is a beautiful use of technology to tell you about demand and supply. And I think model portfolios that have, give you a very rapid input mechanism, and it does all the thinking for you, and it's going to find the stuff where the money is going. And if that's not working, probably we should be cautious. So on that note, forget all that for now. Enjoy the 4th of July and the long weekend. We're about to go get on bikes, and we'll see you on the other side of it, and we'll assess again where we are. That's all I've got. Call it good. That's good enough for the first half of 2026. Hope you all have a very happy 4th of July celebration. Thank you for doing this. We always we appreciate your use. I continue to believe this platform it's the greatest disruption to tools for retail traders